Okay, good evening. You're all very welcome to this evening's webinar. This evening, our webinar is titled Save Tax and Plan Smart. And my name is Pearse Kelly. I head up the Drystock Knowledge Transfer team in Teagasc. And giving our presentation this evening and answering questions and going through the figures is Kevin Connolly from Teagasc. So Kevin is our farm financial management specialist, and Kevin is going to give our presentation this evening, and we'll take questions and answers. Just a couple of things. This is the first of two webinars. This evening we're going to look at the whole area of where can people plan for this year and in the coming years ahead to save money. And on Thursday evening, we're going to look at investments specifically around the whole area of the times three scheme. So where can beef farmers specifically look at making investments on their farm and maybe spending some of the money that we're going to talk about this evening. So we'll have, on that we'll have Shamie Nolan will be going through that, and Alan Dillon will be presenting it. So this evening's webinar is a joint initiative between the beef team in Teagasc, but also the FutureBeef and the Dairy Beef 500 programs. I'd encourage people, we're going to have a lot of slides. We're going to go through those pretty quick, but we're going to take a lot of questions too. And the value in these webinars is in answering the questions. So we're going to look for people to put questions in. There's a Q&A, an option there on your screen. If you have a look down, you'll be able to see in the Q&A where to put in your questions. And we will try to our best to get to as many questions as possible. We'll try and batch a few questions together and that. But this webinar will be on for the next hour or so. So Kevin, you're very welcome to the webinar this evening. Thanks a lot for this. I suppose the year that's in it, we decided we put on this in that there's very high cattle prices that are there. We know from National Farm Survey, we know from profit monitors looking ahead, we know from our demonstration farm programs and from working with them that we are looking at a year where there is going to be significantly higher profits in 2025, and there's still time at this stage for people to plan ahead. We're only on the 22nd of September. A lot of people will be going into their accountants to start finalising tax for last year. So there is still time. So that's really the purpose of this evening. So I don't want to steal your thunder, Kevin. I'm going to let you start sharing your presentation, and we'll take it from there.
Okay.
So I think, as we said, talking among ourselves, Kevin, we'll take this bit by bit, and we'll take questions as we go, rather than going through the whole presentation. And that's so we'll try and tease out some of these finer points. So thanks, Kevin.
Thanks, Pearse. Yeah, I suppose as Pearse says, it's a timely time of the year to be looking at this particular topic, because it's on most people's minds. They're either have already been in with their accountant, or they're gathering their stuff together and going in to get the good news or the bad news, such as it is from their accountant. And I suppose my aim in this talk tonight is to highlight some areas that you could bring up in a discussion with your accountant and get them to assess whether some of these particular options might be an option for you to look at in lowering your tax liability. So as Pearse outlined, this year and 2025 in particular has been a boom year in many ways. We've seen buoyant cattle prices, and that's kind of going to generate potential issues for tax, where a lot of people maybe wouldn't have had a significant issue with it previously. Because the value of sales in cattle farms is up, profits are going to be up. We've seen significant price rises for finished stock, finished cattle, and a corresponding increase in the other categories down along the way as well. And if you're in a breeding system and selling stock, okay, you're in a good position in terms of the prices that you have that you're getting from the market for those stock, and that's going to filter its way through to your profits, which is going to generate potentially some tax issues for you. If you're in a trading system, you're going back out on the market then again to spend some of that hard-earned cash back to restock again. So maybe there's a slightly different issue there, but again, a lot of people will be looking at profits as a result, and that's a fairly maybe unique position for some dry stock farmers to be in. They mightn't have had to worry too much about tax over the last number of years, but this particular year they could be looking at moving into a higher tax bracket for the first time. And what is happening at this time of the year, really, you're actually going back and looking at the 2024 tax year and finalising your 2024 tax liability before the end of October or running into the middle of November for electronic filers. But you'll also then be aware that 2025 is a good year, and that's going to generate a tax liability which you're going to be kind of fully fixing up by the end of October next year. But you have some planning to do if you want to try and control that, and that's really what this particular talk is about. So as a way of preparing the ground for this, I just wanted to run through a very quick skate through some of the basics in income tax calculation. And as I said, this 31st of October is a kind of key deadline where you're kind of finalising your tax position. And at the minute, we're looking back at the last completed tax year as the 2024 year and fixing up for it. And that runs from January to December, and wherever your accounts year finishes, and it might be running with the calendar year, it might be finishing on the 31st of December, or it might be finishing at any other stage during 2024. But whatever your accounts year, where you have an accounts year end that ends in 24, that's the set of accounts that are used to calculate your taxable income and your subsequent tax liability for that year. By the 31st of October coming, which is only a month or 5 weeks away at this stage, you will have to file, or your accountant will be filing your tax return for 2024, basically stating what income and expenses that you clocked up during the 2024 trading year. You'll be paying any balance of tax that you have to sort out for that year. You will have paid some of that tax ahead on account last year, but you'll be fixing up the balance if there's a balance to be paid for 24. But the other significant job is that you'll also be paying your preliminary tax by that stage for the 2025 year, and that's, I suppose, really what we're looking at in particular for this particular talk. So the preliminary tax payment for 25 is essentially paying ahead. The year is still ongoing. You have finished your accounts year end, might have already finished at this stage for 25. But some people might be running with the calendar year, and there's still a quarter of the year left to do. But your preliminary tax is essentially paying ahead for what the potential tax liability will be for 2025. And there's a number of options for this. You can either go the route of trying to work out what your taxable income will be and work out what your tax liability will potentially could be on the basis of that, and take 90% of that and pay that as your preliminary tax. And that has to be obviously calculated or forecasted on the basis of what's already gone or happened in 25, and then maybe a little bit of looking forward if there's still a couple of months left before your accounts year end. There potentially could be problems with that because of the fact that 2025 is such a good year. That could be a significant whack of money to have to pay over in terms of a tax liability. The other options you have is to take 100% of the tax liability that fixed you up finally for 24, which you'll have kind of decided and sorted out, as I said in the previous slide, by the end of October anyway. So you take the full amount of that and you pay that as your preliminary tax. And then there's another option there to go back even further back to the 2023 year and take 105% of that and pay it over as your final liability. Most people, their chosen option is to go for the last year's tax liability and pay that ahead for their preliminary tax. And because 2024 was maybe not as good a year, that could be the chosen option for people. But there is a bit of a health warning over that, because 2024, the income situation there was so far behind what we're looking at potentially for 2025 based on what we're seeing in terms of sales. Then you could still have a significant amount to pay as a balancing amount when we get to October next year. And that's the kicker really in it, in that, will you have the cash, will you have the money there to finally sort out that 2025 liability when you get to October next year?
So that, just on that point, Kevin, I mean, it's an important point to emphasize that, yeah, listen, you might go into your accountant today and he might say, yeah, listen, you don't have a huge tax bill because this in 2024 wasn't a whole pile different than 23 or 22. And then you look in your bank account and you go on at the end of this year, or, geez, I'm very healthy here. And as you say, it's a risk from a cash flow point of view that even from a managing money going forward, that's not necessarily your money in the bank account there today. It's the taxman's money that you just haven't yet given him for 2025.
That's the danger, Pearse. Yeah, and the problem is, as we know, farmers money doesn't kind of sit around in accounts too long.
Yeah.
It tends to be spent, and if it's spent, and it could be spent kind of legitimately on things around the farm or restock,
Yeah.
whatever it is, but revenue
But,
still
but if
has
you
to
don't, but if you
come.
don't have as good a year next year, you could end up having to borrow next year to pay for this year's tax liability. And we've seen that
Yeah.
in the past in other enterprises where they've had very good years followed by not so good year, and
Mm.
then they're into the bank to have to borrow to pay a tax bill after going through a very good year, which is a pity.
It is a pity. It is a pity. So it could be prudent tax planning to pay a bit more in terms of your preliminary tax at this stage when you have the cash there, and just pay a bit extra, and at least you have it paid forward on account and less to pay next year. But most people, I suppose, their first point of contact when they go into the accountant is, give me a figure that's the lowest that I need to write the check for now.
I'll
And
worry about I'll worry about next year. Next year.
I'm worried about next year. But as long as you are aware, as you said, that money still has to be sorted, that liability still has to be sorted. So you need to plan for that, either put that money aside or make sure that you have it available next October to
Yeah, it's
sort.
a good idea. Maybe put it in a different bank account or put what you think is 90% and put it away. And if you do need it for cash flow for other things, fair enough, it's there, but at least you
Mm.
have it put aside. Yeah.
Yeah.
Okay.
Yeah. So then just to kind of trim the last few bits then for the income tax side of things, just to prepare the last bit of ground on this before we get into the meat and drink of this presentation. The tax rates and the bands are set out in front of you there. And the standard rate band is 20%. That's the kind of lowest tax rate, and that's paid up to certain thresholds or up to certain cut-off points, as they're called, the standard rate cut-off points, and they're there in front of you. So for a single person, up to 44,000, you still pay 20%. Anything above that, then that cut-off point, you're into the higher rate at the 40%. For married one income situation, then you have up to 53,000 before you move into the higher rate. And if there's a two income married situation, then you're 88,000 at the standard rate, at the 20% rate, before you move into that 40% rate. And that's, I suppose, an important thing to keep in your head, that those two rates, and there's a certain cutoff point where you move from one to the other. And as soon as you cross over that, then anything above that cutoff is immediately open then to the 40% rate. If it was just as simple as that, then that'd be fine. But there's other bits and pieces of taxes then as well. You have the Universal Social Charge, the USC, and that's a kind of a sliding scale. Again, bands. I haven't put up all the bands there on this slide, but it runs from 0.5% right up to 11% in terms of the different charge, and you move up gradually. The system of tax in Ireland is called a progressive system, where the more you earn, the more you end up paying. So you start off at a low level and then gradually build up as there's more income there. But the max is at 11%. Now that only kicks in where incomes cross 100,000. So it wouldn't be that common that would be kicking in on a lot of farms. PRSA then has been around for a good while, and that's set at 4.1%. Now that is actually on the increase. It's sat at 4% for a long time. And it's up to 4.1, and it's going to gradually increase over the next number of years up to 4.7% when we get as far as October 28, I think. And that PRSA it's a tax, but it's strictly speaking, or it was set up originally to fund the likes of pensions and so on, the contributory pension and other pensions. And so that's in place, and as I said, it is increasing. The thing about what the marginal rate, you often hear people talking about the marginal rate of tax. That's essentially the maximum rate that you're going to the maximum tax rate that you pay on some of your income. So as soon as you clock up the full year 20% standard rate band, then you're into the 40% plus then your USC and your PRSI on top of that. And if you were earning good money from cattle this year, 70,000 plus, you could be paying up to 52.1% on every additional euro over and above that. So that's a significant whack of your additional income that's going in tax. And that's the area that you're trying really to manage, or one of the areas that you're trying to manage is to try and keep as much of that out of that high tax rate and just at the 20% rate if you can manage it.
Just a quick question there on that one, Kevin. Just in terms of the two incomes at the 20% and 88,000. If someone's in a farm partnership, they're still considered individuals anyway, aren't they? Partnership or no partnership, or maybe explain that one. Does a partnership have any impact on that 20%?
Yeah, well, a partnership is just a trading structure. From a tax point of view, the partnership isn't taxed. The individuals within that, the individual partners are taxed, and so there's a partnership, and then the income is split up by a profit share, and then each of them are taxed individually. If you're a married couple involved in a partnership, then your income would be usually jointly assessed, and you're back looking at those standard rate cutoff points in terms of the share of income combined together and compared against, say, if it's the two incomes coming in, then you're looking at the 88,000. But I have a couple of examples later on actually looking at partnerships as one of the ways that you can kind of manipulate or use that 20% rate.
Yeah, we'll come back to that. Okay.
The tactics that really you can look at is as I would say them, a 5 set out here. Using those tax bands that I've gone through, kind of splitting up your income, making sure that you get as much as possible in at that lower rate, and you're sheltering it at that rate as opposed to exposing too much of your taxable income to the high rate. Because that's when the tax really starts to mount up. Every additional euro could be subject to that 52.1%, or if you're at real high levels, it'll be up to 55%. So then other issues around spending, if there's still 3 months left in the year, and if your tax year, your account year was running to the end of the year, there'd be potential maybe to still spend a bit of money and spend it in the right way and be cute about it to get other benefits, and also kind of get a tax deduction as a result. Using accelerated capital allowances, then the options around that, we'll talk through some of those. Pensions, always a common theme when we talk about tax, and any that are listening to turn on the radio at the minute coming up to the tax deadline, sure, there's pension ads coming at you left, right and centre, and there's a good reason for that, and we'll chat about that later on. And then income averaging as a way then of managing your taxable income, we'll have a look at that. So the first option then is just using those tax bands and splitting your income, really maximising that 20% band and looking to try and limit the amount of income that's going to get hit with that top rate of tax. And the 3 options that you can look at for this is to pay family wages. Looking at a simple tax partnership, just very, very simple setup to split income between usually family members and make use of the tax bands and credits. And then go on a more formal partnership route using a registered farm partnership, which is an add-on, I suppose, to the tax partnership with a number of benefits, which we'll mention. There are kind of health warnings or things you need to watch and be careful of when it comes to this. You need to be aware, and your accountant needs to be aware. And these are the things that it's important that they will tease out with you. The other people that you're bringing into the equation here, either paying them a wage or bringing them in as a partner. Look at what other sources of income have they got. If they have an off-farm source of income or some other source of income, that could limit the effectiveness of utilising their 20% band to shelter some farm income, because they've already used some of that for the income they have. And then if they are making use of or availing of any means tested social protection payments, and you drop income in on top of them, that could affect their access to those payments if they're means tested, because the means test will look at the income that's coming in from either a farm wage or a partnership share of profits. So those are things that are important, and that's where these things have to be teased out and thought through very carefully with your accountant. So just looking at the paying family wages one, first of all, just what are the features of that? How does that work? The wages are paid. You're essentially paying a family member, whether it be your son or daughter or maybe your spouse. So they're set up as an employee. You're their employer if the farm is essentially in your name, and the wages have to be paid. They're paid over, and you're operating them through the PAY system. So you sign up as their employer, they sign up as an employee. You do kind of regular returns on the basis of making those payments over, and the wages have to be paid. They're paid over into a different account under the control of whoever is getting those wages, and they then become a deductible farm expense, the same as if you were paying a non-related person as a labour unit coming in at the farm.
Just on that, Kevin, do you have to notify the revenue every month? Is it a monthly notification, and is that something you can do, or do you have to go through your accountant to do that?
There are systems now where you can do that yourself, Pearse. Some people prefer to work it through their accountant and to keep everything right. But there are systems that you can actually do that yourself now. They've simplified it, but you'd need to have a little bit of IT knowledge, and that could be one of the things that you're paying maybe a younger person in the house to do. You're paying them a wage, but part of their work could be actually making the return, doing the PAYE returns. So the spouse of the child that's getting this wage has to be for genuine work done. You can't just pay them a ball of money at a very high rate because that'll immediately throw red flags up for revenue. So it has to be a reasonable wage, kind of working off the minimum wage or between that and maybe the farm relief wage, the farm relief rate for work done. And it has to be based on, if you're looking at a child 14 or 15, you can't have them rattling around doing 60-hour weeks. You're talking they can only do a certain number of hours when they're at school going age or school time, and then if they're on holidays, then they can clock up 35 hours, I think, for a 14 or 15-year-old, moving up to 40-hour week during holiday periods for somebody 16 plus. The thing about this is they activate their own 20% band, if you like, their own income standard rate band, and they can also pull in their credits. So essentially there's income moving across to them, and you're accessing a whole other income tax band at the lower rate and the associated credits with that. And that's where the benefit is in sheltering some of that income. You're getting rid of that, I suppose, out of your taxable income by paying it across as a wage. They're taking that as income and they're using their own band. So the overall tax position across the family, if you like, is lower as a result of that. I suppose the ideal outcome, I put the last point in there, is that if these wages are actually used by the recipient, by the son or daughter or spouse, to cover some of the expenses with running the household and so on, or to cover future education expenses that they're put aside for that purpose, that you're not going to pay out on the double. You're paying them a wage and then eventually having to pay money for college and so on top of that. If some of that can be put aside by the young person in the case of education expenses for their future or current education.
And just on that then, Kevin, so you're talking there about the 20%, but there would be a sizable amount that when you bring the tax credits in, if they don't have any other employment, so if they don't have an off-farm job or they don't have they could get 14, 15,000, could they, maybe a bit more, without paying any tax in terms of income tax?
Up to 20,000 actually, it could be covered. The way the tax credit system has gone now between the single person's tax credit and the earned income tax credit, it will cover off nearly 20,000 of.
And that would be at 0% basically.
0% income tax. Now there will be a bit of USC and PRSI to be sorted there for that, but and definitely USC. PRSI slightly different. If they want to make contributions, they can. But they're definitely, it will shelter a lot of tax just using those individual credits to offset any income tax calculated. Right. The advantages of this system is that it's relatively quick to set up. Your accountant can kind of set that all up for you reasonably quickly, register with revenue and so on. It's flexible in that the wages can be varied, so you can pay a bit more if you have maybe a good year, you can pay a bit more up to certain levels, and if things get a bit tight on the farm, then you can haul them back. At that stage, it's easier to negotiate those maybe with family members than with a non-family member coming in as a labour unit. There's no change in ownership of control involved. You're still keeping full control of the reins, if you like, and the money is managed through a wage. And there is an option there for people for the recipient of the wage to build up their pension entitlements if on the back of that, and pay a bit of PRSI. So I suppose the disadvantages is around that whole admin of operating PAYE on the wages and setting that up and getting used to it and getting the discipline of making the return. And then you have a bit of employer PRSI if the decision is that they're going to start contributing PRSI to clock up their credits maybe for their future pension entitlements or other entitlements, then you will be operating employer PRSI in that as well. Now there is an option to avail of Class M PRSI, and provided their wage doesn't cross £5,000, you can get away with paying no PRSI, and they're living in the same house as the farm owner. And the farm owner is operating on the basis of a sole trader. If they're operating on the basis of a company, then PRSI must be operated on that, regardless of whether they're family members or not.
Just two questions on that, Kevin. One is, can I retrospectively go back at this stage and pay someone in January, February, March, April this year, or is it too late at this stage to go back and do that? And the second question is there a minimum age that I can start paying a family member at?
The first question, no, revenue will expect to see regular kind of wages going out as payments. You can't kind of do this in bulk at the end of the year or halfway through the year and backdate wages. They will expect to see it, at least on a monthly basis, or maybe, ideally kind of on a more regular basis than 2 or 3 times a year. And it has to be operated through the PAY system, and the various taxes paid at that point when the wages are handed over, and they must be handed over and paid into an account at that time, under the control of the wage recipient, the owner, if you like. In terms of the age limit, 14, 15 kind of is your kind of minimum age. At that point you'd be starting, and they're only talking, as I said earlier, I think it's 8 hours a week during school time, and the max is 35 hours a week, and you're outside of school terms, if you like. And then but it's the rate at that stage. I mean, they're only kind of doing basic labor around the yard, so you wouldn't, you'd be talking about minimum rate at that stage.
Just an interesting question in here before we move off that. It's like, can you pay your father a wage if you're, let's say, just for a few weeks together, just for the summer? So let's say we're going to have a busy 3 months, and you say your father is there, he's no longer. It's not a partnership, I presume, is what they're saying, and that you want to pay him for 3 months in the year, but not for the other 9 months, say.
Yeah. It's flexible enough that way. You can set him up and pay him a wage. Sure, that would be common enough.
Okay, thanks, Kevin.
Okay, so then I suppose, as an example, just a very simple example, if we have someone has our son engaged on the cattle farm doing a bit of work, paying not a massive amount of money, but €16,500 annually, when you tot it all up. Mary's taking a deduction for that 16,500 as a farm expense. It's clocked in as a wage, same as, and an expense the same as all the other expenses that she has on the farm, and that's deducted from her total income to arrive at her taxable income. So she's essentially shifting, and we'll assume that she's paying some tax at the high rate. So her marginal rate is sitting at that 52.1%, and that's what's she's actually saving 8,500. If you left that 16,500 in as her taxable income, and she was paying 52.1% on that would be clocking up another 8,500 of tax for her. So she's essentially getting that off the books, moving it over to John. What's John's position then? As we said earlier, his personal tax credits are wiping out any income tax that he would be paying on that. There will be a bit of USC and PRSI. As soon as you cross €13,000, you're liable to USC, Universal Social Charge, and PRSI. If he decides he's going to make a contribution for PRSI, that'll be owing at 4.1% as well on the 16,500. So there'll be a bit of tidying up on those two, but the big saving is on the income tax side.
And let's say John had a part-time job in the local supermarket, and he was bringing in, we'll say, 200 quid a week, 10,000. He will have a little bit of tax to pay, but it's still a long way off the 52.1 that his mother would have to pay, isn't it?
Absolutely. Yeah, it would be like he still has access to 44,000 of a standard rate band there before he moves into the higher rate. So and he has 20,000 there that will be covered fully by his single person's tax credit, assuming he's still single. Presumably he is at 18, and then you have the earned income tax credit as well. Both of those together are 4,000, and 4,000, if you clock that up at 20%, that covers 20,000 of income before he will have any tax bill. But so he's allowed a bit extra working off farm before he kind of starts paying tax at the high rate.
Just one or two questions in on that before you click onto that one. I mean, implications for that family member social welfare pension entitlements later in life, it's probably positive implications, is it, more so than negative?
Well, yeah, he's starting to clock up his work up his entitlements earlier. Make his contributions earlier. If he's going to continue working on ahead with no breaks, he'll have his contributions kind of in place then for the high rate of contributory pension further down the line. So it's definitely something that again, that there was a report in Generation Renewal released recently there just last week at the ploughman, and that was one of the things that they're trying to encourage more people to start making PRSI contributions earlier to make sure that they get access to the contributory pension.
And going back to that father example, if the father had a pension, that's going to be considered the same as an income, no different than anything else, is it? Like, so if he's bringing in whatever 250, 300, I don't know what his pension is, but whatever it is per week, that's considered income, no different than anything else, is it, Kevin?
It is, yeah, and it's taxed under the PAYE system as well. Like you have to register for that for income tax on the contributory pension. So any wages he gets for the farm is also going to roll in on top of that, and all be considered then as part of his taxable income. Yeah, yeah.
But
So
but it wouldn't reduce his pension. You're allowed to.
no, no, no,
Yeah,
no. Sorry, his contributory pension. Once he's made his PRSI contributions and he's entitled to his contributory pension, it doesn't matter what income you have after that. You get that. The only implication it would have for him is if he was in a means tested non-contributory pension. Then if it's means tested, any income he takes in could affect his pension at that stage.
okay.
So contributory pension
Yeah.
won't be affected. So if we move on then just to look at the partnership side of things, then as a way of I'd say moving income across to somebody else to allow them to access that lower rate band. The simple tax partnership is it's not a Department of Agriculture registered partnership. It's basically the farmer and their spouse and the other child just coming together under a simple arrangement to allow splitting of profits as a partnership. Profits are split, and then as we said earlier, the partnership isn't taxed. Each partner is taxed on their share. So there's a profit share, a document there, an agreement in place, basically saying what percentage they're taking out of the business. And that allows then the profits to be split across two or more partners and allowing them to each take a share to offset against their own 20% band. And that's what, rather than having one person to absorb the lot and some of it moving into the higher rate with only one 20% band, you're accessing more. And if you have a couple that are going into a partnership, married couple, allows both of them to access their 20% band up to 88,000 at 20%, as opposed to the married one income, which is only 53,000. So and then they each get to access their own individual credits as well, and that offsets some of the tax liability. So the advantages is that, as I said, there's more there at the 20% instead of being pushed into the higher rate. The overall USC is also lower because it's a progressive and it's moving through bands as well. You're pushing more down into the lower bands because each person then is assessed on their own income against those USC bands. And there's no employer PRSI paid on a partner share because it's just a share of the you're not employing the other person. They are an equal partner in the business, or a partner in the business. That might be unequal shares, but they're still regarded as a partner as opposed to an employee. So there's no employer PRSI, but each individual partner will be liable to Class S PRSI on their own kind of share of the profits. The disadvantages then around that, there will be additional kind of accountancy costs, maybe preparing the partnership accounts and doing returns then for each individual partner, but usually the benefits usually would outweigh.
And is that difficult? I mean, if one partner is bringing no assets, if all the assets are in one partner's name, and that does that cause any issues, Kevin, or is there ways and means around that, I suppose?
It's not. Asset ownership doesn't come into it at all, Pearse.
Okay.
You can decide to split the partnership, the profits of the business any way you want. It doesn't necessarily have to fall that the partner that's contributing all the assets, say that owns all the land or owns all the stock,
Okay.
the lion's
Okay.
share. You can manipulate
And is
it.
that something that can be set up fairly quick, or is it a cost
Reasonably
in?
quick, yeah.
Yeah.
You just need to have the accountant would need to have something there to basically show that this is kind of set up on these. This is what's agreed, and there's a profit share to back it up, to just back up the splitting of the profits. You can't. It's not a kind of an ad hoc arrangement that you just decide go in and say we're going to split it kind of 60-40 or 40.
Yeah.
No, 60 or 80-20, whatever it is. You need to have that kind of decided and something there to back it up. But it's reasonably straightforward to set up.
Yeah. So again, as you said at the start, this is a conversation with your accountant to go through. Yeah.
It is. Yeah. And this is the kind of thing. And this is something I suppose you really need to be having now to set it up for next year. You can't kind of retrospectively do that for 2025, unfortunately, at this stage. It's something that you'll be setting up for 26 if we can see the likes of what we're going through at the minute, if that's going to stick with us for a number of years, this might be something that you'd like to kind of set up for the next few years and have the ground set up to allow you to get the benefits out of this in 26 and further on.
Great.
So the likes of then this, how does it work in practice? If you take an example, say of a farm that's making 60,000 in profit and there's a 50-50 split then between the two spouses as partners, they're taxed on 30,000 each if it's a 50-50. And then if they're spouses, then they're accessing the two income 20% band, so that's up to 88,000 in total at 20% before you move into that higher band. So that's giving you 7,000 less assessed. If you look at it across the two incomes and the two partners coming together, and so that's where the saving is. So that's 1,400 less in tax, as a result of moving, having two incomes and splitting it across two 20% bands essentially. The USC then is also going to be lower because neither person is going to hit that very top or get to those higher levels of USC as quickly because you're splitting it across two people who are starting at the lower bands and moving their way up through it. And as I said, if you were at a level where you were at 100,000, that potentially would be 11% USC. So there'd be a big saving. The higher income that you go, if you're able to split it, the more savings can be made there on the USC side. Then if we look at kind of taking that a stage further then and moving to a registered farm partnership, which is now officially registered with the Department of Agriculture. And again, it's very similar to the simple partnership, but you're taking that extra step in registering it. You need a legal agreement in place. You need a non-farm agreement. There's a bit more paperwork, bit more work in registering certain rules that have to be followed as regards eligible partners for it. But the advantages are, in terms of tax, are quite similar to what we've already gone through in terms of the 20% band and lower USC as well. But you also have access to other benefits as well because of the fact it's a registered partnership with the department, and that's been set up as a kind of an incentivized way of bringing people together. And we would be quite in favour of that in Teagasc from a number of reasons, apart from the incentives there, but also from the point of view of looking at bringing people into the business that, where from a succession point of view, the next generation or other people to come and work together on the farm. So the likes of the tax benefits, that there are additional tax incentives that are there. You have enhanced stock relief. I'll talk a little bit about stock relief later, but the normal rate of stock relief is 25%, but you get access to higher rates of stock relief if you're in a registered partnership, which can be of considerable benefit if you're talking about increasing stock or revaluing stock. If you're then looking at maybe doing a little bit of investment on the farm, around the yard, and spending a bit of money on sheds or facilities and so on, then there's additional TAMS benefits, and I know there's going to be a TAMS talk later, a webinar later on this week, which will go through that in a bit more detail. So you get access to higher ceilings and a higher rate if there's a young farmer in there as well, which can help kind of fund some of the investment that would be happening on the farm if it's required. And then you have the succession farm partnership option there, which is a kind of an add-on again to the registered farm partnership, which facilitates the handover of the farm assets. Now, a partnership, as Pearse asked the question earlier about assets and so on, partnerships don't look after anything to do with assets. The assets are kind of licensed in by whoever owns them originally. Partnership is just a way of trading as a business, and allows you to, as I split the profits and so on, and manage that relationship on an ongoing basis, but it doesn't look after the asset side, whereas a succession farm partnership has an add-on to it, a legal agreement that sits alongside, which ties the two partners together in terms of the transfer of assets over at certain times, and that opens up then this additional benefit of a 25,000 tax credit that can be split. That's over 5 years, so 5,000 a year each year over 5 years, and that 5,000 is split between the partners in terms of tax credits, and they then can be used to offset against income. So there's an income tax reduction benefit there by utilising those credits, and that can make a big hole in any tax liability as well if it's properly used. The disadvantages around, I suppose, having a registered farm partnership, there is a bit more paperwork involved, and there's potentially more setup costs involved. The department don't actually charge anything for the registration process, but there'll be a little bit of additional accountancy expenses, maybe some legal expenses as well. There is a collaborative farming grant available, operated by the Department of Agriculture, which can largely offset all of those expenses. You can contribute or put in your receipts and so on up to 3,000 of expenses associated with setting up the partnership, and the department will apply a grant of 50% of that. So you'll essentially get 1,500 back on a spend of $3,000 on those type of expenses, and that'll make a right hole in those in getting the partnership off the ground.
The big thing with that partnership, Kevin, is the joint herd number. This is for the registered farm partnership. Yes. Joint herd number and the joint bank account. They're the two big things, really, aren't they, to get in track before next January, February?
Yeah. You have to have a joint bank account anyway, and the herd number kind of has to be moved over. Set up as a partnership, and maybe if there's people coming in with both have their own herd numbers, one herd number would have to be made dormant, and they use one herd number for the partnership, and they're both associated with that herd number, and then for the purposes of trading as a partnership. As you say, the joint bank account is critical as well. That's a key.
And is that key then also for the previous partnership, the tax partnership, or you don't go down the registered farm partnership and you just have a tax, a joint bank account for the farm? Yeah,
you need a joint bank account for the simple partnership or the straightforward partnership as well. Yes, that would be a key part of that too. But it's a official requirement, if you like, to get registered with the department and having that joint bank account in place. Whereas I said there's no registration process with the previous one at all. So the other, I suppose, to throw an example at that, if you take kind of a father-daughter partnership, again, just bumping up the profits a bit more, just for the purposes of this example, going up to 100 grand, 50-50, so split, that's 50 grand each. Making use of two separate bands. Now, these are separate kind of people, are not spouse partnership or spouse assessed. So you have 53,000, assuming that the father there's one income, so him and his spouse have only one income, and then you have 44,000 available for the daughter. That's again pushing more into the 40% band, into the 20% band, and less into the 40% band if there was only one taxpayer there. And if you look at then the whole area of say if part of that process, when the daughter comes in, that she has plans then to bump up stock numbers and drive on with the farm, and as a result stock numbers are increasing. And the thing about lifting stock and lifting the value of stock is that can be painful enough in the early years, because that value is treated as profit, even though those stock are still walking around on four legs, and they haven't actually been cashed in yet. But because the closing stock, the value of the stock on hand at the end of the year is higher, that filters its way down through to profit and could be taxed as profit. If they utilise the stock relief benefits that I mentioned earlier, where each partner then takes that 36,000 lift in stock that I have on the bullet point there, and they split that 50-50, so each of them will take 18,000 of that lift in stock, and then they apply their own stock relief to that. The young qualifying farmer, assuming the daughter has a green cert and is under 35, that full 18,000, her full 18,000 stock lift will be offset against her profit. She won't be taxed on that at all. So that gives her an option, that farm an option to build up stock numbers at no cost, at no tax cost over a 4-year period. That's limited, that 100% stock relief, for 4 years from she first starts trading in her own right under the partnership. So that's a handy, I suppose, for those that are maybe going to drive on in terms of scaling up the farm and increasing stock on the farm, utilising that stock relief through a partnership, while still maintaining the outgoing generation, the older generation and younger generation working together, works particularly well.
And that stock relief, you're probably coming on to more of it later on, are you, Kevin? I mean, we talk about increasing stock, but in terms of increasing the value of stock as well.
Yeah. I will talk about that later on. And again,
Okay, we'll cover that then.
utilizing those 100% rate if it's available could be a way of actually lifting stock value safely, if you like, without exposing yourself maybe to additional tax. The other thing, just to tidy up on that before I move away from it, is I've talked about credits a few times, and you need to make use of the credits available. Credits basically are a full deduction against your tax, your final tax bill, and there are some reliefs as well, or allowances there that'll help reduce your tax bill, and those reliefs or allowances are sometimes available at the high rate of tax. And you should be claiming all you're entitled to and being aware of what you could be entitled to. Some of those credits are automatically applied. So, if you're tick the box or on the return that you're married, you'll automatically apply the married credit, and other credits will come to you automatically, such as the earned income credit and so on. But there's others, kind of outliers, as I've called them here, that you have to actually do a little bit of work for in order to claim them. And it's important that you're aware of those and make your accountant aware that could be something maybe that you need to look at. I suppose the onus will be on you to gather the necessary information in order to be able to claim this and allow your accountant to put in the information on the return. So I've just picked out two here. These are the kind of common ones that could be being overlooked in your tax return. The likes of health expenses. There's most families are paying out significant amounts of money maybe over the whole year on expenses, if for all family members, and that's if the main taxpayer is covering all the health costs for the family, and then they're allowed to kind of claim those as expenses against or credit for those expenses against their own tax if they are making the actual payments. So the likes of expenses to cover GP costs, consultant visits, any kind of non-routine healthcare, hospital visits, and so on, that you can claim relief on those at 20% of the cost. So that's kind of fixed at that 20% rate. If you move into the likes of nursing home expenses, you can actually get relief at that, or credits at the higher rate, at the 40% rate, just on nursing home expenses, if some of your income is exposed to the 40% rate. You do have to gather together all your receipts and tot that all up and categorize it out into the different categories, whether it be GP or prescription costs and so on, and the likes of non-routine dental care and so on. So not the likes of extractions and cleaning and so on. It's something the likes of orthodontic work, braces. Half the country's walking around with braces on their teeth at this stage. So the like of that, you could be offsetting some of that as an expense at 20%. But you have to gather together your receipts, and as I said, do a little bit of work in tidying them up and supplying that information to your accountant, and you'll be able to claim a direct credit for that, and you might as well. The other one is the mortgage interest tax credit. Those of you that have a mortgage on your principal private residence. This was brought in 2 years ago to allow, because of the big increase in interest rates at that time. It allowed for a tax credit to be calculated on the basis of whatever interest was paid in 22. If there was a lift in 23 and 24, you were allowed to kind of claim the difference, basically what the lift in interest cost for that to service that mortgage for 23 and 24, and claim a credit for that. Now that credit is capped at 1250, so 1250 for each of the years. So you could be lifting an additional 1250 for 23 and 24. You had to have a mortgage in place, obviously, back in 22 on your main residence, and the balance had to be between 80 and 500,000. And you do need to have the documentation from your mortgage provider to say that this was the balance in 22, this is the balance in 23 and 24, and this is the interest that was paid in each of those years. And you submit that information in, and your accountant should do the rest. But again, it's a credit that's there to be got, but doesn't automatically come to you.
Just a couple of questions that are there on the health expenses one. Kevin, health insurance, so you're paying VHI. Is that deductible?
No.
No.
You get a credit against the cost of your health insurance at the time you pay. It's hard to believe it, at the cost of it at the minute.
Yeah.
But and it's only going up. I understand all the health insurance providers are putting their charges up at the moment. One thing just in relation to health insurance, when you mention it there, Pearse, if some of those costs that I have up there on the screen, the likes of GP costs and so on, consultant visits, if you're getting anything back from your health insurance through, because you have cover there for those type of things, then you have to offset that. You can't claim those as a full cost if you're getting something back from your health insurance. So you have to net that off before you come out the final cost in order to put it in expense.
Yep.
Stock relief and the stock values, you mentioned it earlier there, Pearse. So I suppose just to go over what stock relief is, it's basically a deduction for the increases in stock value that happen on the farm from the beginning of the year to the end of the year. If your closing stock is higher than your opening stock, that's a lift in stock, and you're allowed then to set off that, get relief for some of that lift in the value of that stock. And this is kind of unique to farming. It doesn't happen in any other business that I'm aware of anyway. And why that's so important in a farming situation is that we all know stock numbers can fluctuate on farms, and depending on kind of, particularly in trading farms and so on, you could have differences in numbers. And then that will impact on the value of the stock. And if you have a lift in value at the end of the year, that feeds its way down into profit. And if you don't have anything to protect some of that, then you're going to end up paying tax on that. Now, every farmer will get a standard stock relief at 25%. So the other 75%, unfortunately, there's nothing to save you there, but at least you're getting 25% of that lift in value offset as a relief before your taxable income is calculated, your final taxable income is calculated. If you fall into this category of, as we mentioned earlier, if you're in a registered partnership and you're a non-young farmer, and then you can get 50% stock relief, so half that lift in value can be offset. And if you happen to be in a position where you're a young trained farmer, and for the first 4 years, you're allowed then claim 100% of that. So that's a useful concession in terms of offsetting some of that lift in value. I suppose that Pearse kind of referred to it earlier, the whole thing about at the minute when we're talking about what's happening in 25 and the increase in stock value. People are maybe rightly quizzing their accountant, well, what about looking at how my stock are valued in the accounts, and maybe I should be increasing the value of the individual, the way individual animals are valued on the accounts to bump up that, to make sure that I'm not paying excess tax on those and generating profits where I could be kind of reducing that by increasing the stock value. The danger with that is that, as I said, if you try and increase your stock values, that you'll be doing that at this stage. Your opening stock for the year will be already set because it'll be your closing stock from the previous year. So you'll be increasing your stock values on the basis of increasing your closing stock value. And if you increase your closing stock value per head and multiply it up with the same number of head, you're going to end up with a higher stock value at the end of the year, and that's going to feed its way through to profit. So you will gain some of that benefit back by starting with a higher opening stock value the following year, but you're still then faced with, well, what impact is that going to have on my taxable profit for this year that you're actually carrying out the increase in. So that's the danger with this, that any increase in say the closing stock would increase the profits, and that's going to kind of impact the taxable values for the current year and the taxable profit in the current year. As I said, you will gain the benefit the following year. So you do need care, and that's something that you need to, I suppose, discuss with your accountant. What's the implications of doing that? And we're hopeful that this kind of lift in values and the lift in the trade that's there at the minute is going to continue for a few years at least, and maybe that would be on the back of that, it would be worth kind of lifting the stock values a bit, but you need to kind of make sure you do your sums as to what that impact that's going to have on your taxable income in the year that you do it, that you don't end up blowing the doors off in terms of the amount of tax you have to pay just to get that lift in value, and then wait for the benefit to kick in 25. So you need something to set that off. If you're in the category of where you have somebody that's fitting in and is getting 100% of that stock relief offset, well, then there's no danger there. If you had, or you could.
But just on that, Kevin, say, is there still an opportunity for people who are only putting in 2024 accounts now to look at closing values last year and closing values this year? Kind of, is there a benefit?
There is, yeah. And again, look, that's it's back to whether you have or want to pay additional and sort out an additional balance for a higher 2024 profit on the back of it. And if the cash is there, maybe it's something worth doing, in putting in a higher closing stock for 24. And you'll probably have a preliminary tax bill or preliminary tax payment for 24, which is going to leave, if you lift your stock values this year, it's going to leave a significant balance to be paid. If you have the cash sitting there to do it and you have no other place to put it, then it might be worth kind of looking at spending a bit more, paying a bit more in tax to take that on the chin, if you like, take that rise in closing stock values to set yourself up then for the 2025 year. But you do need to be aware that there will be an impact there if you have no other way of sheltering it.
Unless you're getting some of these big reliefs through farm partnerships or young trained farmers. Okay.
Then if we talk about spending, then smart spending, as I've called it here, such as it is, and then looking at whether you're spending money on revenue items or capital spending. It obviously has to be focused. Spending for the sake of spending just to save tax, as it goes without saying, is not great. You need to the money should still be spent on the basis that it's going to generate something else other than a tax benefit. Ideally, something that's going to improve soil fertility, something that's going to upgrade maybe building work, focus on, better facilities to allow you to handle stock and so on in a safer way, and do something around the yard, maybe to tighten up pollution control or something like that, would be money well spent. And if it's, spent in that way and gets a tax benefit as a result, well, happy days, everyone's a winner. So it's targeting those things is vitally important. One of the things obviously is the whole area of soil fertility, and maybe spending, I suppose when it comes to this time of the year, this year, the scope for going mad on buildings and yard upgrade is limited, and particularly if you're talking about availing of any grants. I suppose that the horse has long since bolted to get anything off the ground in this calendar year, with only 3 months or so left of it. So, spending money on the likes of soil fertility through spreading a bit of lime and a bit of potash, a bit of clay going out this time of the year, that's a direct kind of expense that can be offset against the income for this year, and it's it's a good time of the year to be doing it, and it's deductible in the year of spend, and it's going to give benefits to you in terms of grass response to that fertility improvement in grass for next year and in subsequent years. So it's a good investment and should be looked at. Then you're into the whole area. Then the kind of the other type of spending, maybe doing bits of work around the yard and so on. And then it's back to whether it's a repair or a capital spend. Repairs, basically, when revenue look at this particular type of expenditure, to get something classed as a repair and get a full deduction in the year of spend, it has to be a like for like fix. You have to be replacing something that's already there. You're not putting something in the new. It's not a complete new development or a new improvement, if you like. It's replacing something that's already in place, and that's classed as a repair and fully deductible in the year of spend. Once you go then into the territory of putting something in the new, as I say, in the yard, or doing something completely new on the farm, then you're classing that as capital, and you don't get a full deduction for that in the year you spend. You have to split that out over a number of years through the capital allowance system, and we have farm buildings allowances at 15% over 6 years and 10% in the last year, and then you have plant and machinery allowances at 12.5% for 8 years. So those are the allowance. That's the way that those capital items are spread. So you're not getting the same benefit. You're not allowed to take the full whack against your income in the year that you're actually spending the money for those capital items. You have to spread it over a number of years through the allowance system. And the other thing,
I wanted to go in there, let's say I had an old cattle crush and I wanted to do up that and spend a few thousand on that. It is replacing, like it's a crush, it's a yard, whatever. Not putting in a new crush, Kevin. Yeah. Is that considered repairs? Yeah.
That's a repair. Yeah. Once it's replacing something that's already there and you're upgrading it, then it's still a repair. You're still kind of replacing.
But I won't be able to get VAT back on that.
You won't be able to get VAT back on it, and that's the point. Once you claim VAT on anything, then it falls into the category of a capital item. So you're kind of balancing that out, like of whether you want to claim the VAT back on it. That you're going to have to forgo of taking the full that is a full deduction in the year that you've spent it. And obviously, if there's any grant claimed on it as well, then it falls in as capital. It's not regarded as a repair either. So that's an important thing to emphasise. You can't have kind of jam on both sides of the bread, be kind of claiming the VAT and then also throwing the whole lot in then as a repair in that year.
Okay.
So the other, I suppose, as an example, I've thrown in, say, as regards a repair, replacing kind of cracked slats, which is, there was slatted tank there. Slats have been there for 20 odd years, starting to show wear and starting to become a safety issue for stock and man alike. So if they're replaced like for like, then that can be fully offset as a repair and a cost that can be deductible against current year profits. If you go out and instead of replacing the crush that you were talking about, going out doing a completely new handling unit out in the new, and that's a cost of say 40,000, fairly fancy kind of handling unit, and you get a grant on that, and you claim VAT back on it, leaving a net cost there of 23,500. That then is spread over 8 years at 12.5%. And that's then that allows an annual deduction of just short of £3,000 against your taxable income on the basis of that. So you're not allowed to offset the full 23.5 in that case against your income in the year spent. So one of the things I threw in there, just I think if you want something classed as a repair, and if there is a case of something that's you get audited further down the line and you have to stand over it with revenue, it'd be a great help to your case if they did start to query, and they won't generally query that much that I'm aware of anyway, unless the cost starts creeping up into the 8-10, into a significant amount of money. They might be kind of looking at it and wondering, is that really a repair, or is it something on the new? If you have photos and invoices, in case of your crush there, Pearse, if you had a few photos showing the old, what was there originally, and then you're coming in then to replace what's there, then that would be useful evidence to have to back up your claim. The accelerated capital allowances scheme then is schemes that are available then are useful just to be able to take this money if it is regarded as capital and take the allowances a bit quicker. And it allows kind of the net spend on certain buildings and equipment purchases to be claimed over a shorter period. So the likes of there's 3 different kind of tranches or allowances there that something could fall into. So you have the likes of storage and associated equipment. You have farm safety equipment that have their own set of allowances, and then you have energy efficiency equipment, and they can be taken as deductions against taxable income, and then that's compared against your bands and your rates at that stage. And they're a very useful thing to do if there's a significant spend happening and you have the money there to offset against your taxable income. So the slurry storage ones, you're claiming the allowances over 2 years instead of kind of the 7 years or 8 years. That slurry storage and handling equipment it's mainly kind of slatted tanks and associated buildings with livestock. There is the likes of scrapers and so on, automatic scrapers and things like that would be classed as equipment, but you're allowed kind of take those over 2 years at 50% a year, as opposed to the 7 or 8 year write-off that would be normal. And as I said, it covers animal housing, collecting yards, scrapers, aeration systems are included in there as well. The farm safety equipment wear and tear allowances scheme then, it was introduced back a few years ago now at this stage, and there's a list of different items that are covered on that. And again, it works the same way. You're allowed to take it at 50%, so over a 2 year instead of the normal 8 year. Covers the likes of big bag fertilizer lifters, cattle crush anti-backing gates, the quick hitch system for the 3-point linkage in the tractor, allowing you to take on and off implements at the back without having to, get off the tractor and get down into the danger zone at the back of the tractor. You have your cattle crushes and sheep handling units, calving gates, floodlights, although they could be covered onto the energy efficiency one as well. Calving cameras, sliding doors instead of swinging doors or hinge doors due to the kind of safety issues with those hinge doors and wind and that. So and there's a whole section there on tractor disability aids as well for people that
at the ploughing this year, Kevin, I see a lot of interest in these. They're not fixed cattle crushes. They're the crate at the front of the crush where you have your weighing scales and your head scoop and your backing gate. Would they fall under farm safety? I see you have fixed cattle, but would they also fall in there?
They would, they should do, but they have to be fixed to the ground. They have to be bolted to the ground. There is a kind of an issue with those sometimes on the VAT reclaim side of things that, in theory, revenue don't allow or don't like kind of giving VAT back on anything that could be, in theory, unbolted and lifted and sold off the farm. They like it to be kind of part of the building itself, but those crushes should be, provided you have the likes of an anti-backing system on it and a head scoop or something like that
Yeah,
included on it. It should all.
because there's some of them with the squeeze box and that are substantial costs. Between I know there's a grant available on them and that does bring it back down. But but before grant, you could be looking some of those be up, including VAT, 10, 11, 12,000. Yeah,
Yeah, yeah. We're doing a bit of shopping down at the ploughing then,
I
obviously.
was looking anyway, Kevin. Yeah,
So the accelerated system, capital allowance system, just as an example on that, back to our crush again that we were talking about earlier. The normal allowances, as I said earlier, over the 8 years at 12.5% on that 40,000 unit that we put up, with a net cost of 23,500 after grant and VAT, is coming in at just short of 3 grand. A deduction against taxable income. If you use your accelerated allowances at 50%, you're allowed, 11,750 of a deduction straight off for each year. So it's a substantial additional deduction against your taxable income for that year. If you have that investment in mind and you have the money there to do it, and it's needed on the farm, and what farm couldn't do with upgrading their handling facilities. A lot of farms could. So it is something maybe that could be looked at definitely for next year.
yeah. And I was just going to make that point, Kevin. Some people are kind of looking at going, "Geez, I'm not going to." I mean, there could be planning permission. There could be different things involved. They're not. It's probably gone for this year for something like that. Even trying to get a builder at this stage to come in and do that work, but it's something for next year and the year after that. Yeah, it could do a lot for you in terms of yeah.
It could, apart from the safety kind of benefits as well, in handling stock. It's I suppose there's less help knocking around yards now to be able to do various jobs with stock, and you end up having to maybe do a lot of these things yourself and having good.
And makes handling stock more attractive for the next generation. So
Exactly,
we're trying
exactly.
to encourage them. That yeah. Okay, we'll keep going. It's 5 past, Kevin. We'll better
Okay.
keep yeah.
Okay, so the energy efficiency then stuff is I'll not labour the point on this one. It just covers kind of the likes of motors, lighting, and so on. The likes of lighting yards in an energy efficient way, you can claim 100% allowance. It's a particularly good one, but they have to be on this triple E register, so that you have to kind of consult whether they're available for the allowance or not. So, but the allowances is pretty attractive. One of the things just before I move on is that they should be these kind of capital spends. They may be attractive, the tax allowances, but they need to be kind of absolutely needed and affordable and justifiable without the allowance, I think. And if it's a case that you're going out to borrow money, if you don't have the full whack of money there to cover that you need to, you should be, aware of that you could be paying back a loan on this when maybe profits aren't as good. Just to talk a little bit about pensions, and I'll be quick with this. Because I suppose, as I said earlier, there's a lot of talk about pensions when it comes to this time of year, and really it's the traditional one that a lot of people use to reduce their tax bill, and you get, and the reason is so widely used is you get relief with your top income tax rate. And now the maximum relief that you get depends on your age. The older you are, the more you can whack into a pension and get relief on it. You'll still end up paying USC and PRSA on it, so it's just a relief against income tax only. You will have to still pay USC and PRSA on that money, and then you're putting money aside for retirement that you can take money back out again as a lump sum, and the balance then used to supply a pension. And that pension, when you take it back out again, you're going to be taxed on it. Ideally, pensions work best if you're putting money away at the time when you're sheltering money at sheltering tax at the high rate, and you're pulling it back out again when you retire and only paying the low rate at that stage on it. That's when it works particularly well. Take a quick example here at 10,000 of a contribution. We put that in and this taxpayer or this person that's making this contribution is paying the high rate of tax. That's 4 grand of an income tax saving, which is 10 grand at 40%. So that 10 grand would have been exposed to 40% tax, and you're putting it into a pension as a result. Now you're still paying out the 10,000. That 10,000 has to go. You're not handing it over to revenue, but you're paying it into a pension. So you're still paying out the 10,000, but you would have had to pay 4,000 of tax on that anyway. So it's important then that that you realize that the net cost of that pension then is that pension contribution is only 6,000. So you're getting the actual net cost to you of putting 10,000 away in your pension is only 6,000, because you would have had to pay tax up to the level of 4,000 on that. And you're building that fund then to supply you with an income in later on in later years. But the kicker is, I suppose, you don't get access to that until you hit your pension age. And the aim with pensions is, as I said earlier, save tax at the high rate and then pull it out at the low rate when you're not paying as much. Lastly, then, just quickly, the income averaging side of things is an option that's there, been there a number of years, been tweaked a few times, but it's an option basically to allow you to average out a number of years together, smooth out the profits, good years and bad years. And the current system is allowing you to average out over 5 years, so the current year plus the 4 previous years. And you can once you opt into averaging, you have to stick at it for 5 years. Capital allowances are not averaged, so it averages just the profits, and then the allowances, whatever the allowances are in that particular year, you use those as an offset then to arrive at your taxable income. There is a step out option that allows you to kind of bail out of averaging for 1 year in any 5. You can only play that card once if you like, and it's usually availed of when profits fall. So averaging works well when profits are continuing to rise year on year, and if you hit a year where profits plummet, and you end up kind of paying on the basis of an average of taking back previous years of high taxable income, then you can decide to kind of step out and just have yourself taxed on the current actual year's profits. So it doesn't really change. It doesn't change your overall real cash profit, and doesn't change kind of the tax position on the longer term. You're just changing the timing of it. You're just changing when you actually pay the tax. So it's smoothing it out, if you like. Revenue will still get the tax off you, but it's not kind of up and down and fluctuating wildly. You're paying it out in a more smooth fashion because it's averaged out over a number of years. And to take an example, take the 5 years there in front of you, and you can see the profits have been rising on this farm and sitting at 60 grand there for 2025. Under normal rules, that would be your taxable income for 2025. And there'll be a certain amount of that obviously getting hit maybe at the high rate, on the high rate of USC and PRSI. If the taxpayer elects to use income averaging, that's averaged out over 5 years, and if you average that out, of those 5 years of profits, there comes to 35,000. So instead of 60,000, they're being taxed under income averaging at 35,000. And that's shifting money out of the 40% band that they would have been exposed at the higher rate. But the USC and PRSI is also applied to the average profit as well, but at a lower overall rate as well. Income averaging can be useful. I know some accountants are dead against income averaging, because if you do hit a low income year, then you end up kind of getting hit with more tax than you should be getting hit with. And the problem with that is usually those low income years, you have less cash to pay it. So just looking at the action that you might need to plan at this stage, you shouldn't wait until, I suppose, this time next year to think about your 2025 tax. Start thinking about it now, some of those options, talking to your accountant and weighing up some of those tactics that potentially you could use to keep your tax bill under control, because this requires a bit of planning, not rushing into it, not kind of picking something when you're pushed to the limit and there's a deadline coming to actually pay the tax and you have to do something in a hurry. Best to plan for it. Your accountant is the best source of advice for this. They know you, know your business, have an idea of your spending history, know what works and what options would best suit. So your accountant or your tax advisor is the place to go, and go to them early and make use of them. I suppose, just to finish, the tax liability, I suppose, that we're talking about at the minute, and it likely will be higher than most of you are used to. It's still, it reflects a good year, growth of the farm, success of the farm, if you like, where profits are increasing. It's an opportunity. Okay, it's another thing, maybe another bill to pay, but it's still a positive reflection of what's going on in the farm. It can be planned for. You can, control it. And put kind of measures in place to try and limit its effects in terms of an additional bill, and maximise the reliefs that are there. And that's all to do with working with your advisor, working with your tax advisor, your accountant, just to look at what options are there, look at the rules, and put a plan in place then that's going to help you out with that. And I'll just finish very quickly, Pearse, just to mention, I'll give a quick plug to our clinics that are coming up. I didn't mention any taxes, capital gains and capital acquisitions tax and stamp duty and all those things that farms that sometimes would be looking at when they're talking about transfer, and that's a whole kind of separate line of work altogether, but that will be dealt with in their transfer in the family farm clinics, and you can see them up on the screen there, the different locations. There we've had these over the last number of years. We have them in 6 locations every year, and these are the different locations. We have Galway, Roscommon, Tipperary, Waterford, Cork, and Monaghan as well, and the venues are up there on the screen. If you want to register for them, just scan the QR code that's in front of you there with your phone, or contact the local office and ask to be booked into the clinic. Any that are of a mind to do something around transferring the farm, and even if it's a good bit down on the horizon, they're well worth attending, and they're good chance to check out and get all the latest information and advice from experts, in that whole area. So I'll leave it at that, Pearse.
Yeah, and there's big interest in those, isn't there, Kevin? So you do have to book into them, and that, yeah. So
huge interest every year, and booking in helps us just manage the numbers on the day itself.
Yeah. Okay, thanks, Kevin. Listen, I'm going to bring Martina in here for a couple of minutes, maybe 5 minutes. I know we've gone well over time, but there's a lot of really interesting, and there's a savage amount of questions. We're hitting there for nearly over 100 questions. We're not obviously going to go through all those. We'll be here till late into the evening, Kevin. And I think the point is, as you say, this evening's was to get people thinking for the questions they're going to ask their accountant, and those questions you're asking there, your accountant. Martina, is there any burning questions there that are kind of coming in?
Just a couple, really, I suppose. And I suppose one goes back to the young trained farmer. Like, there's a lot of, I'd say, them on here, and they're looking at, well, okay, I'm a young trained farmer, my 100% stock relief, what exactly do I have to be in? Is it a joint herd number tax partnership, or a registered farm partnership, or do all above count?
All of the above, and out on your own as well. I mean, if you set up on your own as a young farmer and start farming in your own right, your 4 year, there's a 4 year kind of window that you get that stock relief for. So the minute you start trading, set up a herd number or get attached to a herd number associated with a herd number as a young trained farmer, and stock starts moving through that herd number, that starts clocking up your 4 year period. And that allows you, as I say, to claim 100% relief for that 4 years. And the one thing I suppose that we find is that some young farmers, get a herd number and do very little with it, maybe for a year or two.
Too early.
Yeah, and then have, suddenly then decide that they're really going to get the skids on and start building up stock numbers, but they've already kind of used 2 years for they're doing very little, they're pushing very little through the herd number. So you need to be kind of nearly ready to go, ready to rock and roll, and have your plan in place. You do need to have a business plan and get it certified by Teagasc in order to avail of that 100% stock relief. But once you have your green cert in your back pocket, your level 6, and you have access to a herd number either in your own right or through a partnership, then you should be able to access that stock relief, 100% stock relief.
Okay, perfect. So, like, if you were looking at some of these people that are after starting off now, they should really be maximizing the stock or the value of the stock, because they're going to get the 100% relief on it for the next, as long as they're within that 4 years.
Yeah.
Okay. A good few came in here as regards, the machinery, the tax allowances, the accelerated allowances. Is there lists anywhere for those? Like, so can I go on to revenue.ie or whatever else and see those lists? And the other one is that, do second-hand machinery come into account for your tax allowances?
Yeah, they can do for you can get capital allowances on second-hand machinery for sure. But as regards lists, if you go up onto if you put Google accelerated allowances slurry storage, and that'll bring up kind of a list. That there is a document there on the department website, and I think our own website has it as well. As regards those items that are covered on that, and also the likes of the safety accelerated allowances as well. There's a list. The safety one, you actually have to apply in advance for it and get a certificate. Basically, get a qualifying certificate to say that the investment qualifies for the allowance, accelerated allowance. So it's a slightly different kind of application system. But all that information is available on the Department of Agriculture website.
And then
Just a
just on
quick one on
the
that. Sorry, Martina, on the stock relief, the women in farmers, I know they're for some of the grants they qualify. Is it the same for stock relief, or is it just the young trained farmer, Kevin?
Just young trained farmer.
Okay.
There's a separate category of TAMs for women farmers, but no, there's no separate
Stock
stock relief
relief.
for those. It's just a
Okay.
young farmer. But I think the stock relief for a farmer in partnership, either a non-young trained farmer, you get that 50% stock relief as a non-young trained farmer in a partnership, and that's
Okay.
that's open ended. That doesn't run for the 4 years. That as long as they stay in partnership, they get that 50%.
Okay.
And then there's just ones there on the income average, and do you have to be, can you set it up for 1 year and step out? How long do you have to be in it? And if you step out before the 5 years, is there an
Yeah,
issue? Just a few rules
no, you
around.
have to commit. You have to commit the 5 years for it, Martina. And you can step out during that. There is a kind of a waiting period. I'm not sure kind of how many years you have to. I think you have to be a couple of years in it before you can take a step out of it. But you must commit to at least 5 years. If you do step out, you'll have to still go back in to clock up your 5 year period. And sorry, what was the other part of your question? What
Yeah,
happens if
it's
you
just
exit it? Yeah, if you exit it, that's where the kicker is in it, because you'll be reassessed based on your actual profits and the year you bail out of if you bail out before your time in income averaging, you were paying an awful lot less tax as a result of bailing of averaging. You could end up in the year that you leave averaging getting hammered with all the additional tax that you should have paid in the previous years. So that needs very careful consideration and assessment before you do something like that.
and once you go over the 5 years, you can take it on an annual basis, or do you have to sign up for another 5 years afterwards?
No, you can take it on then on an annual basis then after that, but you must stay in at least 5 years into it at that stage. There's an initial 5 year commitment, because it's a 5 year average that you're working off all the time. You have to stay in for 5 years.
Okay, and I suppose just on that then is like there's a good bit of information after going through tonight. The recording is going to be up, and we'll try pull those lists, any extra information that we can, and we'll put it all up onto this one site. I was going to say we try and answer a lot of the questions that didn't get answered, but
No,
there's 105 in it. So
there is. I think there's one we discussed earlier, Kevin. It didn't come up in the presentation, but maybe just to say a few words on it. Company.
yeah.
People are starting to look at that now and kind of say, well, if I'm going to make these big profits for the next few years, should I be registering as a company?
Yeah, it's kind of quite popular as a query coming in, all right. And there have been a lot of farms that have moved into a company, albeit most of them are on the dairy side of the house, over the last number of years. I suppose the big attraction of the company is the corporation rate at 12.5%, and people are looking at 12.5%, and the kind of rates that I had up earlier are 52% plus. But if the companies really only suit a certain cohort of farmers that are going to be throwing off big profits, and I suppose the key question for a company is you're in as a director of a company. The company becomes the farmer, but for you to get money out of that company for your own use, to pay your own family living expenses and so on, and for your own kind of personal needs for cash for various things, you have to take that out. And as soon as you take that out, either as a salary as a director of the company, or as a payment for leasing the land into the company, that's taxable in your hands. And the more you have to pull out of the company to meet your own requirements for income, then that kind of erodes the benefit of the company. Companies work well if you can leave the money in there and use it for funding a future land purchase, or to pay off loans on investments on the farm. But if you need a lot of the money that to take out of the business in order to meet your own personal requirements for cash, that erodes the benefit of the company. And you need to be at a fairly significant scale, I would say, or have access to off-farm income, a significant off-farm income. You don't need to pull out of the farm at all to make it beneficial.
Okay, listen, again, that kind of goes back to the point we've been saying all evening. That's a question that you need to really sit down and talk very closely with your accountant, and they come up with a lot of other options as well, not just that one. Okay, Kevin, it's 9:25. I think there's room for 5 webinars in this in terms of questions and that. But that's good, and it's great to see such an interest, and it's great to see so many people on and asking questions. And I know from talking to Teagasc advisors around the country, this is something that there's more and more being done locally. So keep an eye out, talk to your advisor. If you're in a discussion group, it's a great topic for your group to take on, or bring an accountant in, or a data for an evening to go through some of these questions now that you've got a taste for what's out there. Listen, just to remind people again, so thanks for that, Kevin. This is recorded, so if you're talking to someone, or if there's something here that you think, geez, did I hear that right? There will be a recording up later in the week of this on the Teagasc website. We do have the webinar again on Thursday evening. Alan Lillan is chairing it. Jamie Nolan is going to go through the whole TAMS. We talked a lot about different investments there this evening, and that there's a lot of different vagaries in that, and different rates and different that, and a lot of questions. And I know it's something that there's a lot of interest in. So hopefully some of the people that are on this evening as viewers will come back on Thursday evening. Just to thank Kevin and thank Martina there coming in and in the background and the questions and that, and thank you for coming on and asking all those questions. Apologies we couldn't get through all the questions, but we're already well over time, and we'll leave it here. Thanks everyone.
Thank you.